All right, ladies and gentlemen, I hope you're having a wonderful weekend. Today, I want to talk about how I beat the market makers and algorithms when certain events occur. It's more so how to interpret it and reading the options chains to get an idea of what's happening. This is very, very helpful when it comes to news, and I figured I'd talk about this today. I asked you guys for any recommendations, so even put those below. If you want me to make a video on anything, cover a specific option concept or anything like that, even the stock market, long-term investing, I think we'll do something like that next week, but comment below. And we also have like 900 videos on here to see, so chances are we have also covered it too, but I wanted to share this with you guys today because when we are trading live, I'm going to show you some of these plays that we've seen recently. When you start to see this live, I want you guys to kind of be prepared so you guys can see, okay, well, how does this work? What's going on? And then make a call out in the chat. And if you don't know, we are live Monday through Friday, 30 minutes before open. It's the first link in the description, and it is pinned in the comments. Make sure we see you there. We're going to post a watch list here tomorrow, and then Monday morning, we are going to be trading, baby. So I'm excited to share this with you guys. A lot of you guys have dropped this. I think we just hit 60,000 subscribers, so we'll use that as a milestone to drop these little hacks on you. But I think this will help a lot because we've kind of seen this, and we've seen various differentiations. I don't know if I said that word right, but you think you get what I'm saying in terms of the types of plays. So we saw UNH on Friday. This thing went up. That was a 3,000% gainer out of nowhere. But that one wasn't necessarily news related, but you would have saw something along this line. Then we had Disney the other day, hit another 2,000% there, and this one started to move when the news came out. Then there was FGen. If you guys remember FGen, they had that pop, and then they had that drop middle of the day around here, and the options went crazy. And then this was one of those plays. I got it for $20, but within seconds, people were saying they got filled at 60, 80. Some people got screwed over chasing this, and I think this is what we're going to go over here is going to be able to help prevent that. So there's that. Then Boeing as well too, and Boeing had that news regarding 737s this week. That shot it back up. And then also Walgreens last week when they had that buyout offer. So we've been seeing a lot of different news events occur. Some stuff makes it pop up. Some of the stuff just starts running throughout the day. But now what's the point of all this is how do we differentiate these events? How do we find the best play? And how are you able to let the news drop and still find a good play? These are all very difficult things to answer because we don't know what piece of news is going to make a stock go up. And then even worse, even if we like the news, usually the options get really, really crazy. And that's how a lot of people get screwed over. And we've seen that happen. So the question is, how do we get more information? So now this is where we come to the options chain, because what you guys will notice is that during all of these events, the option chains go crazy and they tell you something. So we're going to be focusing here on spreads and the last trade. So what is a spread? We'll start there, but the spread is the difference between the bid and the ask. So in this case, these 62.50 puts are going for $2.30 on the bid. That's the highest offer, and then the lowest offer to sell is at $2.79. So that's like a 49-cent spread. And then same thing here, 129 to 156 as like a 17-cent spread, and then so on and so forth. And you'll even notice now, the further you go out, and this could teach you something about contracts. When you start seeing higher spreads, especially when we start going after these further out of the money puts or calls, depending on the play, and you start seeing the spreads, like this is a great example right here on Walgreens. These have almost the exact same bid and ask. That is telling you something, and this is what I want to focus on. And even then, you see how these have these asks at a quarter. Same thing even if you come down here. So what's the difference? This is where now we look at the last trade. That is what somebody was willing to pay for in the last trade that got filled. And I've said this in other videos, when we are looking to analyze an option, the bid and the ask is cool. The spread is one thing, but especially when it gets down to volatility. So let's say a news event comes out, Walgreens starts shooting up. The key isn't, part of it is going to be looking towards the spreads and looking towards the bid and the ask. But the big part is what was the last trade. So because what happens here, and this is what we're going to talk about, and tell me if you guys have seen this, a news event comes out and then all of the options that bid and the asks go to zero, or the ask will go to $5, $4.80. And they'll all have the same ask. So the question is, which one do you go for? And this is the problem, because if you go for the 90 thinking this is just as likely as the 75, that's completely wrong. And you could end up spending the same amount for the 90 that would have got you the 75 here. So that's why you look at the last trade to see what value has actually gone through and what's going on. So these are the first two things. and understanding what's happening. But like I was saying earlier there, once you start getting further out the money, you have to really pay attention to the last trade in these bids and asks, because it's easy to get, especially if you're playing a small account or you're just trying to get one of these plays out the money. Don't get fooled buying something super far at the money when you could have put that same bid. Don't get caught trying to pay 25 cents for this when you see the last trade on here was 23 cents. You could try to go for that, or even then the last trade here was at 3 cents. So someone got filled at $3 even though they're asking a quarter. So keep that in mind. We will go a little bit into how these computers work, and this is what I want you guys to understand too, is that these computers have certain ways they go about stuff. So all the time, even though you might not see the ask is saying 25, if you put an order in at 5 or 10 cents, or let's say in this case, even if you put in an order at 25 on Robinhood, don't, because of those brokerages, they might take your $25, but there's usually a whole another depth of orders here. There's probably an ask at 5-10 cents. It's just not showing simply because the availability and volume of it. The computer's job here is to facilitate the market and always keep transactions there, and pretty much they add liquidity. So they take one option order and multiply it by 10, but they're always willing to be in that market. We won't focus too much on that, but moving into this, and this I even have a secondary title to this, how to beat the market makers and algorithms when a stock is volatile or news comes out. But here's one of the things I want you to remember, and this is really the main key here, these numbers to remember. $1.80, 210, but the main one is 480. And I love 480 because you guys have seen this before. So that play was on Monday when Walgreens went out. It's hard to see, and this is why I'm saying you guys got to come live and you'll see this happen, but you'll see fat figures come in. But what occurs now is when a news event comes out, or like we've seen with like UNH last week on Friday, when the stock starts moving a ton, what's going to happen is, depending on what is occurring, if orders start coming in, or the news is changing, or the potential valuation of the stock is changing, the market makers are going to protect themselves and they're going to widen the spreads. And usually you're going to see these three numbers: 180, 210, and 480. I'm telling you right off the bat, 480 is the main number, because if you start to see all of these asks say 480, 480, 480, that means the stock is either halted, it means the stock is moving up a bunch of percentage points, and it means something big is happening. Same thing now, if you see 180 to 210, what you might start to see, instead of seeing 480s, you might see 480, 480, then it'll start going 210, 210, 180, but you'll see the same asks. And those are key numbers to know, because they always go to these numbers for a reason. One, wider spreads indicates there's wider uncertainty. The higher the ask and the higher it is compared to the bid, this is telling you that the market makers have uncertainty. And now think about, why does this occur? And this is what I'm saying, how you could even look at the option chain to determine what the market thinks is going to occur, because why are the spreads widening? Why are they charging 480 for both at the money, in the money, whatever it may be? It's because they're trying to protect themselves. Usually at $480, depending on, no matter what the stock is, that amount usually will protect them if you buy it from them, because they don't know just as much as you do. So if it does go to 480, they're saying, hey, we don't know what's going to happen. That's why they're going to even sell the 75, 80, or 90, even though it may be 30, 40% away. If they don't know what's going to go on, they're going to sell that at 480 just in case, to protect themselves. But again, if all these go to 480, that means something big is happening. So these are the numbers to remember. If it's at 180 to 210, that means something's occurring, and it's not going to be as groundbreaking or big or disruptive as if you started seeing 480 across the board. So an example is like when Walgreens came out, when they said they were going to get bought out, people didn't know what it was going to get bought out for. All the contracts went to 480. But when it was UNH, that news came out, then it went up and then came down. Even Boeing last week, and then on the options that were kind of bouncing all over the place, those went to 210. So that's showing you, and then depending how much time is left on the contract, it's showing you, and now if there is less time on the contract, though, like if there's a day, it'll probably go to 210 instead of 480. But that is telling you the scale of what the market is expecting, because the market makers, that's pretty much their insurance policy. The minute bad news starts coming out, or again, it becomes harder for them to predict the value or to assess it, or it's falling outside of a couple standard deviations. Think about why I say this is their insurance plan and this is how they protect themselves. They start just charging the highest point possible, because they don't know what's going to go on. They don't want to sell you a contract for a few cents and then a few minutes later it goes up. So now, how many of you guys have seen me do that? Sometimes during these volatile events, what happens, it starts going volatile and I find a contract and I'll buy it for 5 cents, and then instantly it'll go up 1,000%. Because this is understanding the system. It's understanding how these computers work, what their job is, and what they're supposed to do, and then now the system. it is centralized, but it's not really centralized. So during the market hours, and again, I want to give you guys this information now, so when you come on live, ask me about this, and I could show you real in person while the market's moving, and you can see what's happening with it. But what's essentially occurring is that not all the market makers are going to be on the same page. Most of them have the same programs, but then this is where I'm saying why you could get filled sometimes earlier. There's different market makers all across the board. There's pretty much like 9 or 15 companies, and they're all going to have different programs there, but sometimes you could get routed through, or one of the market makers isn't going to, their computer won't update fast enough, or it won't set that insurance plan, and then you're able to scoop them quickly. But now here's the thing. This is what you want to focus on. You want to focus on the last trade to determine the value, and then look for specific strikes to lag behind. So what I mean by this is now you have to pay attention to the last trade value. So let's say Walgreens gets a news event, or even any company for that matter, on Friday or on Monday, the news comes out, and then all of these go to 480. If it goes to 480, that means there's a big news event happening, or the market makers are expecting a big price valuation. That's why they're putting their contingency plan in place. If it's like 180 to 280, they're saying there's news, there's momentum, they're unsure, but then if it goes to 480, then you know what's happening. But if that occurs, now your first thing you want to do is look at the last trade, because all of these are going to be at 480. You don't know what's worth what. So you don't want to try to get or like go for any single one. No, the key is seeing the bid and the ask, and then watch the last trade. See what the last trades are at. So now if you see this and all these were at 480, you know somebody was paying 61. And then if somebody gets filled below 480, then you're saying, bam, that's what the market maker's willing to do. So if this guy gets filled at like $1.80 instead of 64, don't bid more than $1.80 on these. Don't bid more than $1.80 here. But the key is try to go slightly above the last trade. And sometimes what you could do is go 100% above the last trade. So let's say these go for $4, and then these ones are going for 23, but you could confirm it's going to be good news. And let's say and again, you need more justification, but then you come in 100% over the last trade, you might automatically get filled, because in the computer's mind, they're saying, well, 100% over the last trade, that's an easy deal for them. And again, one computer may not take it, but another one will, but that doesn't always work. But now the key is finding the last trade to get the relative value, and then find the strike price that lags behind. So depending on how deep the chain is, a good example will be Amazon. Their chain goes so deep, you see how many contracts there's going to be. So let's say news is going to happen. All these contracts will go crazy. And again, sometimes with like, they're not all going to go to 480 on Amazon. They might go to 1480, or you'll see 480, a decimal, another like 3480 or 3580 or 4380, something along those natures. Or sometimes it'll go to 480 and no trades will get filled. But the key is find an option that's lagging behind. And then once you find one that lags behind, you have to see what's it going for on the ask, but then what are the last trades above and below it to get a valuation. But essentially, you want to find an option to lag behind to be able to say, okay, they're not updating this option, or now the further out the monies usually lag or don't get affected, but if they do, something's up. Usually that point where there's a lagger on the option chain, that could be indicating that's to the full extent to the market makers think something's going to happen. Otherwise, that one would have gone up with it. Or usually in the first few minutes, it takes time for all of these computers across all the exchanges to get with the plan and protect themselves. This is what we call, essentially, when I come in and I take those a lot of the time, I'm the slippage for the market. The market's understanding we're going to lose some during this volatility. That's why they're going to protect themselves. And if we're able to snag them up before, that's that slippage. But on the reverse side, too, it's very easy to get caught. All of this, I should say, option trading is extremely risky. You can't lose off almost financial investment. Please consult with a financial advisor. This is educational purpose only. But this is a very, very risky strategy. If you try to chase these and go after these, even if you find a lagger and buy it, again, that is their contingency plan. It doesn't confirm anything. It usually does, but it's not always the case. And then you could end up be paying, literally 1,000 times more for a contract that is worth jack shit. But essentially now, the further out the monies usually lag, or they're not going to get affected. But if they do, something is up. But all in all now, what I want you guys to be able to get from this in looking at how the option chain works is the key is that how the market makers respond to certain events, it could signify how important the event is. So whether it's a UNH type play, Boeing, a middle of the day play or news that comes out, something starts popping, or there's a sympathy, and that's one of the keys too. I will say, if something happens in the news, it's, let's say Walgreens starts going crazy, go look at another company related to Walgreens, and their option chain may not have the same thing, or it's going to lag a little bit more. And there's many ways to look at the laggers and leaders. But when you start seeing numbers like 180, 210, keep your eye out, especially if you see them all across the board. But the minute you start to see 480s and like uniform numbers all the same, that means something's up. And how the options price and then the last trades and what people are willing to pay for, this is giving you an idea into the severity or importance of an event. So this is the first segment I'm going to do on this. I have a bunch of these little tricks and stuff. I know I even have a trick on getting filled at a lower price. I've actually documented that on one of I need to find that video. If you guys have seen it, let me know. If not, we'll give another update on it. But this is the first of many I want to talk about. I want to get you guys educated so you could contribute more in the chat and do all this. But come on live and I'll show you, because nothing beats watching this in real time. And if you have seen me finesse these chains before, you see how to do it. So I would love to show you guys. So make sure you guys are there live. But that is your weekend video, baby. I love you all. Make sure you guys are subscribed, hydrated, healthy, ready to go. We're going to be seeing you on the watch list tomorrow, baby. I hope you guys are ready. I hope you guys are hyped. It's been a good week. Let's keep it going into the new year. And you know what? Check out the other videos, man. Be smart, be healthy, stay blessed, stay grateful. I love you all. Let's go.